Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, February 16th, and then we'll see how things look for Friday, February 17th. We had a pretty significant down day. The PPI came in much stronger than expected. That spooked the markets. They tried a couple of times to take things higher. That didn't work, so we ended up going lower late in the day. And this may appear to be the start of a downtrend or something, but really all we've done is work our way back to the lower end of the range that we've been in for some time now. So really not a lot has changed. We're just at the lower end, where after Wednesday we were at the higher end of the range. So let's go back and talk about what happened. We had a gap lower open with prices going down below S1 at 41.18. We fell down to that 4100 level again, which is a psychological level, which has now become more of a technical level, and that brought in the buyers, and they pushed prices back up. We got back above S1 only to hit resistance at the daily pivot at 41.33. As the day went on, we retreated back below the daily pivot. Prices tried again to get through the daily pivot, but that failed, so we tried a couple of times. Prices fell back below S1 and almost to S2. We didn't quite get there at 4,089 before closing at the low of the session, just slightly above S2. We were down 1.38% on below average volume. We really have a lot of indecisiveness right now. We were trying to look at low volume days when the market's going down as positive. Well, when the market's going up, we're seeing below average volume days too. So that just suggests more of a lack of conviction on either side. The technicals were kind of positive still. We still have that positive backdrop, which is deeper in the background. That hasn't changed. But on a short to intermediate term basis, we're switching back more negative now, but we're still range bound. And that has to do with inflation and interest rates. And that really played a key role in Thursday's session. Here is the intraday chart showing how we gapped down below S1. We didn't make it all the way down to S2. We came right down to this 4100 level. Yeah, we came in a little bit below that, but a base was established here. Buyers started to come back in, push prices back above S1, went sideways for a bit, tried to get up to the daily pivot, came back down, tried to get up to the daily pivot again. That failed 2 times, so then we ended up seeing a lot of selling going into the close, and we closed at the low for the session. What are some comments that we can make? The PPI was higher than expected, or stronger than expected. And this is indicating that the scenario that maybe the Fed is getting near the end of raising interest rates, that might be in jeopardy now. So we're in this realm where good news is now bad news. If we get a real strong economic report, that's going to really spook the markets. The S&P did lose the 4100 level again. And there were a couple of FOMC members, even though they're not voters, that came out and made statements. President James Bullard said that he wouldn't rule out supporting a 50 basis point hike at the March FOMC meeting. He wanted to have a 50 basis point hike at the February 1st meeting. And Cleveland Fed President Mester, who's also not a voter, said that she also wanted to have a 50 basis point rate hike at the February 1st meeting. That together spooked the markets. Now, my understanding is she made the comments before the market tried to bounce back, but it was gone but not necessarily forgotten. And then when you have Bullard coming in making his statements, that really had a negative impact on the market. On a short-term basis, we're still overbought with the Sean trend meter. It hasn't come down from that extreme positive reading. On a long-term basis, we still have the moving average steady. That hasn't come down yet either. But on an oversold basis, the Stochk RSI, which is a pretty touchy indicator, it can go extreme positive or negative really easily and then stay at those levels. But that's giving us an extreme negative reading currently. The dollar was down and interest rates were up, and we're starting to see that. More and more days are showing the interest rates going up, and that's having some real headwinds on stocks. We still have all of our yield curves that are inverted. Sentiment is still positive. We dropped down a bit to a current reading of 69, where after Wednesday's session we were at 74. I'll go over the economic reports on the next slide, and our trend is still positive. We're still above the moving average, believe it or not, and it is getting stronger, and we're also above 20. I'm keeping our bias and momentum at mixed just because we're in this range right now. We're at the bottom end of the range. If we fall down out of that, then things will turn much more negative. But what we've seen over the last week or two is we get down to the bottom of this range and then we have a good up day and we're right back into the range instead of anything really being decided. As far as the economic reports that were released, we had housing starts come in at 1.309 million. That's a little less than the 1.355 million they expected and a little bit lower than the 1.371 million that we received last time. Building permits came in at 1.339 million, a little bit less than the 1.35 million. Last time, we had building permits come in at 1.337, so just a little bit higher than last time, but still lower than expected. Here's the PPI, and that was the big one. It came in at 0.7%. They expected it to come in at 0.4%. The last time we had this report, it was down 0.2%. The core PPI came in at 0.5%. That was greater than the 0.3% expected, and last time it came in at 0.3%. The weekly jobless claims continue to fall. We're at 194,000. They expected it to come in at 203,000. The last time we had this last week was 195,000. The Philadelphia Fed Index came in much weaker than expected with a reading of minus 24.3, where they expected it to come in at minus 8. The last time we had this reading, it was at minus 8.9. Here's the inflation now casting chart, just showing how the red line, that's the CPI, has ticked down slightly. This updates every day. Where the blue line, which is the core CPI inflation, that has stayed the same. The next reports that will be coming out will focus on this green line and yellow line. That's the PCE inflation as well as core PCE inflation. Here's a chart that Edward Yardeni came out with. This is the PPI showing how we really topped out and we're starting to come back down. So we are declining, but it wasn't as much as the market had hoped. This is another thing to be mindful of, is the net percentage of domestic banks that are tightening their standards. The takeaway from this chart is when we're really going up, that tends to precede a recession, and that means they're tightening financial conditions. Well, we're really going up right now. For all of 2022, it shows that foreigners bought 1.6 trillion in bonds, so they're really adding to their portfolios. And it's not because U.S. bonds are the greatest thing in the world. It's just because they're giving the best return out of all the other world bonds that are available. We also had our weekly survey of the American Association of Individual Investors. Showed they did improve slightly. They go up and down pretty much with the market. We're not getting an extreme positive or negative reading. It's a little bit positive because we're above zero. The Ulcer Index still is showing that there is a high level of complacency. Here is the VIX. We came back up over 20, but 20 is still quite a low reading. So this is also suggesting that there continues to be complacency both on the line chart and on the bar chart. And the volatility of the VIX after declining has then ticked back up with the down day that we saw. Here's another thing we're keeping an eye on. This is the VIX to S&P 500 correlation. It hasn't hit this upper line here at 0.8, but we still want to keep an eye on this because the VIX is really low. The S&P is running into some trouble, so this is starting to spike up again. If that happens, then we'll try to evaluate what's going on at that time. Here are the weekly jobless claims showing how they continue to fall. They were pretty much flat. This chart is a little bit lagging. And here's the continuing claims. We want to keep a close eye on that as well. We want to see if things really start to turn up. Even though you're hearing about all kinds of IT layoffs and cutbacks and Disney's making cuts and everything, it really hasn't come through to our jobless claims yet. The ADX continues to be on top of the moving average. It rolled over a little bit, but it's still looking like it's getting stronger. We still default to positive because the green line's on top, even though it declined. Our Arun, it shows that buyers are going away as sellers are starting to come in, so our oscillator is starting to drop down. We're just slightly below 50. Above 50 is positive, below 50 is negative, so this is now turned more negative. The daily chart just shows how we came right back down to the bottom part of this range. We broke through the December highs, but we're still above this longer-term support level. And here's the longer-term chart, just showing you where that support level came from. And at the bottom, you can see where we did drop below the moving average with volume, and that's been that way pretty much all week. The stochastic RSI is now giving us an extreme negative reading. Our oscillators, the slope is starting to roll over, the TSI is starting to roll over. Intermediate term, we're seeing some weakness in the MACD. The PMO hasn't quite crossed yet. The PPO is just crossing now. And then our longer term oscillators are rolling over, but they haven't quite crossed yet. The KST is getting really close. Here's our PMO study showing the PMO is still above the moving average, but a number of days back, we did see a crossover negative based on price and volume. The Swinland Trading Oscillator, this is more positive. We're still above zero and advancing based on price, and we were flat, but still above zero based on volume. Here's the Sean Trend Meter. It still hasn't dropped down below this 80 range, so it's still considered extreme positive, even though it is declining. The BPI really isn't moving all that much. It ticked down just slightly. The NYSE Bullish Percent Index, after spiking up, is now coming back down, and it did decrease a little bit in Thursday's session. Chaikin Money Flow is still holding up fairly well, even though it did decline. We're still above the red moving average. TTM Squeeze continues to fall with the darkened blue bars, so that's more positive with a negative neutral bias. The Go No-Go system has also switched back to neutral with the lighter colored blue bars. And we're still holding up above this anchored moving average going back to the all-time high. That right now is at 40.86. Can we stay above that level? We came right down to 4.89 in Thursday's session. If we break below that, you might see a lot of stop losses triggered and a lot of increase in selling. Short-term fib level, after being above the 100% retracement, we've now dropped back down below that. Longer-term fib level, after coming up to this 50% retracement, we're just running into all kinds of overhead resistance and still coming back down now. Longer-term fib levels, we're still in no man's land. We have 42.13 above current prices, 40.20 below current prices, and we're right in the middle. We are down to the 20-period moving average. A few days ago, we came down to this 20-period moving average, and we were able to bounce up off of that. We're back down at this same level again. Can we bounce again, or are we going to fall through that? We're still above all the moving averages in our moving average tree, except here is the 20-period moving averages. We switched to negative with the Elder Impulse system for the S&P. We're back below zero with the McClellan Oscillator, so that's negative. Our summation index based on price is now declining, and based on volume continues to decline. New highs, new lows, not enough to really generate anything with our moving average, so we're flat with the 5-period and slightly declining with the 10-period. Advanced decline line, we're still above both moving averages, and you can see these red bars here. There was quite significant selling in Thursday's session. Volume continues to drop off, the histogram is declining, and the black line is below the red line. Here's another chart that I don't show all that much. This is the 20-period moving average of the open, high, low, and close. A few days back, we came down to what is the high moving average and bounced up off of that. Well, we're back down to that high moving average again. Will we be able to bounce back up, or are we going to continue to fall down, or are we going to go sideways? Our longer-term moving average study, we're still extreme positive with the 150, and we're just coming off an extreme reading with the 200. The Dow has now dropped slightly below the pivot level, so that takes on more of a negative flare for the month of February. And the diamonds have also switched over to negative. The NASDAQ 100, after coming up to R1, is now breaking back down, and the NASDAQ 100, after coming up to R1, is also breaking back down. The Qs have switched back to neutral. We had one day where they switched to positive. Well, they're back to a blue bar, which is neutral. Looking at a fib retracement from the all-time high going back to the October low, this also shows how the NASDAQ 100 came right up to this 38.2% retracement before falling back. The praying bottom fisher is still giving us a buy signal, although we're not seeing that in price action. The home builders, with the S&P going down, the home builders were down, although the ratio held up a little bit better, so they're having a slight tendency to not go in exactly the same direction, but it's still a really strong correlation. The 10-year bond yield, after coming down to this 200-day moving average, has just been going back up ever since. Looking at some of our scenarios, based on price of the 19-day exponential moving average of the advanced decline ratio, we're starting to drop below zero with the price. We're not below zero yet based on volume. We'll see if that confirms. The 10-day average of the S&P 500 highs minus the lows ticked down slightly. You finally saw this chart move a little bit. It's still extreme positive. That's on the negative side, so it could suggest that this exhaustion that we're seeing is being reflected in this indicator. That's on the negative side. On the positive side was the fact that we were even able to get up to this level in the first place. The 2-year Treasury yield continues to go back up, so we may end up taking out this spike. The 50-period exponential moving average of the new highs minus the new lows is still holding up. This is a long-term indicator, so it takes a lot for this to roll over. Here is the whole indicator, with the black line being the indicator itself and the red line being a moving average. We're seeing a little bit of a tick up in fear again. When this ratio continues to go up, that means that fear is increasing. But we're not seeing that really reflected in our Ulster Index or in the VIX. Our staples still looking viable. We're a long ways away from this spike, so that could end up giving some support to the S&P. But we've been saying this for a long time now, and we're just not seeing a lot of action in the S&P. What's our outlook for Friday? Please be reminded that the markets will be closed on Monday for President's Day. The technicals are still mixed. That's what they were after Wednesday's session, and we're at the bottom of this recent range. We have import and export prices coming out, leading indicators, and that's it. The whole list of geopolitical events that we need to keep a close eye on just to see if they have an impact on the market. Looking at the Stock Traders Almanac statistics for the 17th of February, it's not very good. We're negative across the board at 42.9% of the time. That's when we have up days. That means we have a lot more down days. And it's the same reading for the Dow, the S&P, and the NASDAQ. And then there's all the other things that I go through periodically here. But these are more focused on the yearly backdrop that we're working with right now. We had some Fed speak on Thursday, but it really didn't matter. They paid attention to other FOMC members, not so much to Lisa Cook. Our scenarios, it's hard to go with the down one now because the technicals are mixed. We still have a positive backdrop and some positive signals, but we're in this range. And so that's really preventing any kind of a break up or a break down. It's hard to go with the up one, even though we default to that because the ADX is above 20 and above the moving average, but we're also range bound. If we continue to fall, we'll want to keep an eye on some support levels. And can't go with the sideways right now because the ADX is above the moving average, getting stronger, above 20, and it's positive with the green line on top. Our conclusion, the S&P is mixed and range bound. How's that? Short term, positive and mixed. We are range bound and it could be turning more negative, especially in the short term. Are we going to fall back down below that range or are we just going to bounce right back up into it? Intermediate term, we are still positive overall, but we continue to be range bound and could be turning more negative. Long term, we're still negative because we're above the 200-day simple moving average and we had a recent golden cross. Thank you. Hope you have a wonderful day on Friday. I may take a little extra time over the weekend to prepare the videos because of the 3-day weekend. Doesn't mean I have to push as hard to get those done and posted. So just look for those, with the first one being the daily update that I'll do for Tuesday's session. So have a great day, and I will talk to you in the next video.